Good afternoon, everyone. Again, thanks for bearing with us today with some technical difficulties. And thank you for joining us today. I'd like to begin by acknowledging the traditional owners of the land upon which I stand today, the Yuggera and Turrbal people, and pay my respects to elders past and present. My name is Alice Ruhe, and I'm a partner here at SMB Advisory, and I'm here today with my fellow partners Justin Howlett and Andrew MacNeill, and we're excited, or as excited as you can be anyway, to be able to talk to you all today about director penalty notices, what they are, what you need to know, and what to do if one turns up. Just a couple of administrative things first up. If you're happy to keep your microphones on mute, we do want this section to be interactive though. So if you have a comment that you'd like to make or a question you'd like to ask, just let us know in the chat and we'll call on you. Alternatively, if you just want to write stuff in the chat, you can do that too, and we'll go through it where we can. We're obviously recording the session and we'll pop it up on our YouTube channel and send a link around to everybody who has registered for this webinar. So welcome. Welcome, Andrew and Justin.
Thanks, Alice.
All righty. So with the ATO coming out of hibernation, 52,319 warning letters dispatched last month and 30 to 40 DPNs being issued every day, 300 intent to disclose notices following 29,552 awareness letters concerning liabilities in excess of $100,000, and the election now having come and gone, we thought it would be timely to share some of the wisdom and knowledge we have around this area. Initially, I'm going to have a chat about the DPN basics, and I'll call on Andrew and Justin to just in terms of some of their input and what they've seen in those areas. And then following that, I'll hand over to both Andrew and Justin to fill you in on what we've been seeing from a practical perspective, looking at different courses of actions and what to keep an eye out for. We welcome any comments or queries you might have, including what you might have seen going forward. And I do have a couple of polls that we'll launch along the way to see what everybody else is seeing as well. All right. Here is the well-used disclaimer. We note that obviously this presentation is intended to give general information only in summary format on relevant issues and doesn't constitute legal or financial advice and should not be relied on as such. If you have any specific issues that you'd like to talk to us about offline, please feel free to do so. So, what is a DPN? A DPN is what, you know, the well-worn three-letter acronym for a director penalty notice, and it's a notice that's issued by the ATO notifying directors of a company of a penalty that may be raised against them personally for debts of the company. I'll raise a poll just at this point in time about who's been seeing any DPNs recently, and whilst I'm doing that, Andrew, do you want to maybe talk about a few misconceptions?
I will, Alice. One of the biggest misconceptions about director penalty notices is a lot of accountants and advisors out there think that the personal liability is a result of the issue of the director penalty notice, where it's actually the company directors have a legal responsibility to pay the debt by the due date. And when they don't pay the debt by the due date, they automatically become personally liable for the debts of the company with respect to the company. And it's the DPN which is issued by the ATO, because the ATO needs to issue the DPN to advise those directors of their personal liability before they can actually pursue the debt. And then the DPN, depending on what type of DPN, gives those directors an opportunity to try and remit the debt by either payment or another alternative course of action, which we'll touch on later.
Yeah, excellent. Thanks for that. So of the attendees we've got today, we've got 27% who have seen a DPN recently and 73 who haven't. Interesting times. Share those results. There we go. All righty, moving on. So if a company fails to meet its obligation to pay GST, PAYG and or super, the company directors can be held personally liable by the ATO for these amounts. Directors can be held personally liable for outstanding GST, PAYG or superannuation obligations if they were a director of the company when the company failed to pay the withheld amounts when they were due, and also if they became a director after the date the payment was due, and if they're still a director 30 days after the unpaid amount was due but is still unpaid. That seems relatively simple, but Justin, I think you've been seeing a few in this later camp, haven't you?
Yeah, we have, Alice. So on two fronts. So apart from your traditional insolvency services, we're often called upon time and time to help advisors and their clients who are about to step into a professional role or directorship. And this is one of the things that's always on a ready reckoner or a checklist in terms of making sure the ATO obligations are up to date. Because, and this is probably a different webinar discussion all on its own, this isn't new. So these requirements, these obligations, these red flags aren't anything new. But I guess the reason why this webinar has been created and what we're all seeing in the media now is the ATO, whilst I've always had these powers, they are red hot on this at the moment. And I've got a handful of clients I'm assisting who are caught by this very fact. So the running theme amongst them all is they were a director of a company that was trading. The five that spring to mind actually resigned as directors for a number of reasons, whether it be a falling out or just time to move on. They were under the assumption, naively, as it turns out, that the obligations are up to date, and they are now receiving DPNs. And some of them go back, a number of years. So again, and the whole theme of this presentation today is none of these powers we'll discuss and run through today are brand new as such. They are just being relied upon heavily than they ever have been before.
Excellent. Thanks, Justin. So there's two types of DPNs that can be issued by the tax office, and we call them lockdown and non-lockdown DPNs. And it's probably prudent to mention here that we're seeing a variety of formats of the DPNs being issued, and sometimes it's not automatically obvious whether the notice is of a lockdown or a non-lockdown nature. I think Andrew and Justin have seen a few interesting ones lately, and I'll leave it to them a little later to go through this as we go. I think, Andrew, you've got some examples as well, haven't you?
Yes, I do, Alice.
Exciting times. So a non-lockdown DPN might be issued where a company's BAS and IAS have been lodged within 3 months of their due dates. In this instance, the ATO provides directors with options that need to be undertaken within 21 days of the notice being issued. So those options can include the payment of the debt being made in full, appointing an administrator to the company, appointing a small business restructuring practitioner to the company, or beginning to wind up the company and appointing a liquidator to the company. However, if a company's GST, PAYG and SGC lodgements are not made within the above time periods, a lockdown DPN may come into play. In this instance, the only option to avoid becoming personally liable for the outstanding amounts is to pay the debt in full. At this stage, the company's directors may need to seek their own advice with respect to personal insolvency options. And so it's really important for tax lodgements to be made on time, even if the company is unable to meet the obligations straight away. Now, there are different due dates though, aren't there, Andrew? Do you want to have a go at trying to clarify what the applicable due dates are?
There is, Alice. It's a bit of a minefield in terms of the due date. So I think what I wanted to touch on was, the importance of knowing what the due dates are because of the personal exposure, which then can obviously get put onto those directors if they fail to meet those, the due dates within 3 months of the relevant due date, then they are personally liable under the automatic lockdown DPN. So I'll just quickly touch on. So in terms of a normal BAS would be due 28 days after the end of a quarter. There are technicalities regarding that though. So if the company lodges via the online business portal, they generally have a bit longer, which say for instance, the September BAS, they would have normally up to 28th of October to lodge that BAS. If they lodge via the business portal, they have until the 11th of November to lodge that BAS. And then if they have a tax agent which does their BAS lodgements, then they have up to the 25th of November to do the relevant lodgement before the clock starts ticking on the 3-month period. What's interesting as well is it's always, we'd always give advice to accountants to make sure that the lodgements are up to date, given this personal exposure, regardless of the fact the company can't meet its obligations. It's imperative that they are making the lodgements, or if the company's unable to get the lodgements done, make sure you've requested an extension, because the time period doesn't actually start commencing until the due date, which if that has been extended, it's the concessional date that the ATO is allowed for those lodgements. Where it can get tricky as well is with the superannuation, because you've got 3 months within the due date for effectively for the GST and the PAYG, which is reported on a VAS or IAS. SGC is by the due date. So once you don't pay it by the due date, then and provide the details, and not provide the report to the ATO regarding those debts, then the director is personally liable under the lockdown provisions for that SGC amount. In terms of the superannuation, generally speaking, a company is required to pay its superannuation quarterly at a minimum, and it's the 28th day of the month, the following month after the end of the quarter, that the SGC or the super is required to be paid to employees. Where they don't meet that obligation to pay their superannuation, then they have until the 28th day of the following month to report the SGC statement to the ATO. And that's the due date for the DPN regime, which means that if they don't meet that due date for the SGC statement by the 28 days the month following the end of the quarter, so they've got 1 month and 28 days, if they don't meet that, then they can become personally liable after that due date. And it's really important that, and I think there's a lot of misunderstanding at the moment about STP. So, STP obviously is where, wages are processed via the, Xero or whatever that processing system that the company has, and then the payments are pushed through to the ATO via the STP portal. But the legislation regarding DPN regime hasn't kept pace with that. So the GC statement is still required to be lodged by that due date, and that's when the relevant date for the legislation kicks in for the DPN regime. So it's quite a bit of a minefield, and that's why we'd always say for accountants and advisors, make sure you get those lodgements in by the due dates to make sure you avoid that personal liability.
It's very easy to talk about due dates, isn't it? But the actual calculation of the due dates is not as easy as it might seem. Sorry, Justin, did you have something you wanted to add?
On that point, as Andrew correctly said, it is a minefield and it is very confusing, even for our taxation agents and accounting clients. It is complicated. And as I said before, this is not new legislation or powers that they've got. It's just front of mind now because they are relying heavily on it. So as Andrew quite rightly said, lodgement is imperative. Now, unfortunately, we've got 8 clients at the moment we're helping through all sorts of issues, 6 of which are purely because lodgements weren't made by the due date. And the theory behind it was, and believe it or not, was their actually accountant advising this, is if we can't pay it, don't lodge it, because that'll be a red flag to the ATO. Now, the power of hindsight, had they been lodging, no doubt it's a red flag to the ATO, but I would have thought there's red flags there anyway, given the fact that we can't pay, and that should have been the time they put their hand up for us or someone like us, just for that professional advice. And again, the power of hindsight, they would have been lodging on time, even though they couldn't pay. And then when we come down to the lockdown provisions, it's imperative, the lockdown provisions, as Andrew quite rightly said before, the liability is arisen the minute you can't pay it. But in terms of, we get to in a minute, some of the options you can actually have up your sleeve to make your clients better off. If we can avoid the lockdown provisions by the fact they were simply lodged, then we have a lot more tools up our sleeve to make the clients better off at the end of the day.
No, I think that's really relevant in terms of how that sort of works. I'd like to know, I'm going to ask you both, and I'm going to launch this poll in terms of who's been seeing lockdown DPNs or non-lockdown DPNs, both or neither. We know that there's quite a few that haven't seen any yet, but I'm interested, Andrew and Justin, in terms of the DPNs that you've been seeing, have there been a sort of a slant either way to lockdowns or non-lockdown DPNs?
Yeah, from my point of view, it has been a mixed bag, absolutely. But what we've actually started to see too, because we've been very, very vocal in the last couple of years in terms of educating advisors and their clients on this, because I keep saying like a broken record, but these are not new. They've always been around. The problem we've had in the past is the ATO have had a number of tools available to recover debt, such as DPNs and garnishing notices, and some other ones we'll touch on in a minute that are relatively newer. The education part of it is paramount. And the reason I say that is we've done a whole lot of work educating our clients in terms of lockdown and non-lockdown DPNs. and providing examples, redacted examples, which Andrew will run through a couple in a minute. We've seen a couple of the last few weeks that are, I'll use the word being a little bit cute, where the ATO specifically has gone out of their way to say this is either or, and it's clear for the accountant or the lawyer involved to actually differentiate what we're dealing with here, so we know, has the horse bolted or not in terms of restricting personal liability. The last couple we've seen, and look, deliberately or not, I don't know. I've got my own theories. The ATO historically has issued the notice saying, yeah, this is a lockdown DPN because things were unremitted and unpaid. You can't avoid personal liability. The new lockdown provisions DPNs are silent on it, and we've seen both. So in effect, over the last month, I've seen 3 versions of what used to be the one form, which again is alarming in the sense of helping people decipher where they're at, and makes our job some more difficult at times too. And what it does facilitate, it requires the advisor to go back to the ATO and specify exactly what we're dealing with, which will always encourage interaction with the ATO, but it can also often flag issues that we're concerned the ATO might not have joined the dots on yet either.
No, absolutely. Andrew, what about you?
Exactly. I echo what Justin said, really. I have seen both DPNs, and in terms of the wording of those, which I'll touch on later, in terms of the DPNs where you've got a lockdown versus a non-lockdown, they are very hard to differentiate between the two. And they really do make the director feel like they are personally liable and they don't have a lot of options available to them. One thing I wanted to sort of add here was probably, there's been a lot of changes through COVID. There's been a lot of concessions made by the government in terms of, safe harbour for directors and avoiding personal liability for insolvent trading and, changes to the insolvency rules. The whole small business restructuring regime have all been brought in to help, direct business owners get through this difficult period. But there really hasn't been any changes to the DPN regime. Like, it is how it was before. There is nothing due to COVID which assists the director to get through and avoid that personal exposure. And they appear to be the tool of choice for the ATO now. That in the past probably few years, there were garnishees were sort of the flavour, the favourite for the ATO in terms of pursuing debts. But then there was negative publicity regarding those garnishee notices, and I think now the ATO has looked at, well, DPNs are a good tool for them to pressure directors to pay the company debts and make sure they're meeting their obligations.
No, I think that's entirely correct. So I've put that poll up there again. So a bit of non-lockdowns and a bit of both. So we've still got quite a few that haven't seen any, which is interesting but encouraging. And I think, Justin, you were saying a little while ago, sorry if I steal your thunder here, but it seems to be indiscriminate in terms of what we're seeing. They're just going out. Not to any particular segment, not to any particular area. Is that right?
Yeah, absolutely. And just to, I guess, reiterate Andrew's point in terms of, and mine, these aren't new. And the concessions that were made because of COVID, whilst they're long gone now, there's nothing that can be relied upon for defence of these. And just by way of example of how far back these notices go and the liability can extend. So the point there about the SGC and the PAYG and the GST now can be liable for. So PAYG itself is retrospective in terms of how far back, because whilst all this isn't new, our job is to help decipher this legislation for people on the screens with us today, so advisors and their clients. So what does it mean in real life? And the obvious question we get asked is, am I personally liable? And that can, as we've already touched on this morning, it's not always an easy black and white answer or an on-the-spot answer. But then the next question I always get asked is, well, how far back can they go? Because if we tick the box in terms of, oh, well, yeah, we missed those couple of basses, but that was a long time ago, so that won't matter. I've only, I'm up to date from the last 6 months. I changed to new accountants is a really good example. My old bookkeeper forgot a couple, so we got rid of him or her. We got new accountants. So, but the last 12 months, I'm fine. And then the discussion turns to, well, actually, the ATO can go as far back. So with PAYG liability, it's retrospective. It can go back as far as you want. The SGC side of it, from 1st of April 2012. So again, if you're having a discussion around how far back can a super exposure go, and GST is the new kid on the block. So April 2020 is when the GST compliant can go back, which again, the companies that have been in financial difficulty over recent periods, and it depends on which game too. So we've seen a flurry of construction industry clients, which PAYG and GST are predominant exposures when we're talking DPNs. And that's where the bulk of their debt will lie. So unfortunately, the comfort that some people seem to take in, it's okay, I've got a new accountant now and the last few basses are up to date. when this slide in front of us now, unfortunately, it won't tick the box.
Mm.
To add to that, Justin, as well, I think directors need to be really mindful of the lodgements which they do make with the ATO in terms of, I think there was a bit of a mentality for some accountants to lodge like nil basses and things, try to cover off that DPN lockdown penalty, I guess making sure they don't get that personal liability for the directors where they actually don't have the data. Where, end of the day, I think Justin, you saw one of these recently where SGC audit was conducted, significant superannuation was found not to have been paid to the relevant employees. Whilst they lodged their SGC documentation on time, they didn't lodge the full disclosure of the debts which are outstanding, and the ATO issued the lockdown DPN based on the results from the audit, which identified the shortfall which hadn't actually been reported to the ATO.
100%. And long story short, for those with us today, it was challenged unsuccessfully. So the ATO power was stuck. Absolutely right. So the old default position of Justin's been rambling on for years to us to not lodge because it raises a red flag. I'll just lodge nils to cover that off and keep him quiet. It won't work either.
No, that's great. Just moving on. There are some instances where associates of company directors can also be made personally liable to pay outstanding PAYG withholding amounts. Those associates can include but aren't limited to relatives, partners, a spouse or children of the company director. In order for an associate to be deemed liable, however, the Commissioner must determine that the associate knew or could reasonably have expected to have known that the company failed to pay the outstanding amounts. Now, Justin, this is specifically in relation to non-compliance tax, not just DPNs, isn't it?
Spot on. So it's a separate legislation. It's a separate part, but it does go hand in hand with DPNs. So any discussion we're having with clients, and on that note too, any discussion you or your clients are having with another insolvency practitioner, please make sure this is covered off as part of it, because it is hand in hand. So it's not technically covered by DPNs, but we do see them go hand in hand. So essentially, to break it down into real life examples, what it simply means is if the company does in fact fail or fails to remit the PAYG, if the director or his relatives, as stipulated there, the rule of thumb sort of one up, one down. So grandparents to grandchildren, and sideways in terms of cousins, we've seen it attached to their personal tax return. So if they're on a salary of $100,000 and 30 if it was remitted pursuant to their the old school group certificates and PAYG summaries, they no longer get the benefit of that deduction. End of the day, if the ATO didn't receive the amounts withheld, then they're taxed on their full amount. So their taxable income is the full amount, not their taxable amount, the reduced amount. And again, oversimplifying what can be a very catastrophic and complex area of law, but it does go hand in hand what we're seeing with DPN. So whilst, again, this is relatively new, it's been in play for a number of years now, the ATO are relying on this heavily. So DPNs, again, the broken record in me, they have been around forever and a day, but they are the flavour of the month, and I think they'll be flavour of the year or years going forward, as too will these going forward. It dovetails into the additional powers, and there's a whole separate webinar itself in terms of ATO and ASIC's additional powers to clamp down on Phoenix activity, which is what this is really aiming at. But it does dovetail nicely into the DPN exposure. In terms of real life, what we're discussing here today, how can we relate it to real life facts, and how can it impact your clients, and how can we make them better off? This is one of them, for example, that I think all advisors need to be aware of.
Excellent. Thanks, Justin. And while we're sort of on that, we need to understand that whilst associates can be liable, they should not be liable if they can demonstrate that they took reasonable steps to influence the director to make the company notify the commissioner about amounts withheld, took reasonable steps to influence the director to make the company pay the withheld amounts to the commissioner, took reasonable steps to influence the director to appoint an administrator or have the company wound up or appoint a small business restructuring practitioner, or reported that the company had not paid the amount withheld to the commissioner or other relevant authority. Andrew, I'm sorry to put you on the spot here, but I know that we were talking earlier about reasonable steps and how they can play into different defences, but you were saying that, it's not as easy just to prove that you'd have been acting reasonably as you might think when the commissioner is involved. Is that right?
And it's very true. So that I was talking in that context in relation to the defences to a director penalty notice, but it is difficult to prove reasonable steps in relation to what actions you could have taken to effectively make the company be wound up, where if you were a director of a company and you resign from being a director, you obviously have an obligation to, if you're personally liable, you've got under the DPN regime where you might have resigned, but you still are personally liable for those debts and have been issued a DPN. The reasonable steps that you would need to show is to take court action to seek to have the company wound up, rather than just saying, well, I asked the director to wind up the company, he said no. There is, positive action you need to take to make sure to rely on that sort of defence. And it's not quite as simple as, just saying, asking the director to wind up the company.
No, thanks for that. So if a DPN is received, it's imperative that advice is immediately sought from a qualified professional to ascertain what options may be available and how best to move forward. I think we've demonstrated today in the first part of this presentation, sort of not everything is as it seems in terms of it's easy to say when something's due, but how to calculate that might be a bit different, looking at actual amounts being calculated and ways forward. So actually getting early advice from a qualified professional is obviously the best way to move forward. I'm going to now hand over to Justin and Andrew to discuss further what we're seeing from a practical perspective, our current observations and comments. So.
Thanks, Alice. So I'll touch on quickly the DPN warning letters. So as Alice mentioned earlier, there's been over 50,000 DPN warning letters which have been issued to, directors where their companies have tax debts. And these director penalty warning letters, they were issued indiscriminately, and it didn't matter if the company had been in liquidation for 3 years or there's $20,000 owing in tax debts. It didn't appear to be any sort of methodology on why these directors received the notices. The next slide, Alice, has a copy of that DPN warning letter, which I don't know if you can actually see it there. Realistically, like the ATO's website says that these ATO warning letters were really, sent to directors to try and to get them to engage with the ATO. And, speaking to accountants out there and other advisors, it was more like, a scare campaign, almost like to re-engage with the directors, where there've been no activity for 2+ years from the ATO. And we've seen, speaking to clients, over $1 million in tax debts, they didn't receive one of these warning letters or subsequent DPNs, yet someone who's, owed $30,000 has actually received the warning letter and the DPN, or, the company was wound up 3 years ago and it's just about to be, it's been deregistered, yet they're still receiving these. And then they speak to the ATO and they really have no reason. They don't even know what a liquidation is when the director's spoken to them. And it's quite difficult for them to deal with that, when they think that they've dealt with this problem. And then 3 years later, the ATO is issuing these warning letters. I think it just goes to show that this was a tool to try and scare directors into making payment. Particularly if you look at this notice on the slide, it says the warning about the possible director penalty notice for the unpaid company debt, and it gives where it's highlighted they have to pay the outstanding amount or enter into a payment plan. There's no reference to any other options available if and when the ATO is required to issue a DPN. There's no reference to that, the options that they have available. And I think, that's quite clear with the discussions I've had with people, that they just, the ATO was trying to re-engage and trying to get the debt collection started where there has been this significant period of inaction. Have you seen anything different, Justin?
No, you're spot on. And it was actually, fun is not the word, when these were issued, we were receiving, or self-personal, I know Andrew and Alison as well, I was getting half a dozen phone calls a day with these notices, and it was an even split between clients who'd received them saying, what does this mean, what do I do? And the other half was the actual practitioners themselves, so the advisor or the accountant. Because as Andrew said, it's just indiscriminate issuing of these notices. And what we've seen is a worrying trend too of they were sent to the taxpayer or the client directly. Now that's in a number of cases purely disregarded any work that was being done in the background between the accountant and the ATO with regards to that same client. So I've got a number of cases where the accountant or their staff was in day-to-day contact with the ATO about taxpayer X, proprietary limited, negotiating plans or trying to, or ascertaining, where are you at? Here's what we can offer. No, try again. What information do you need? All the usual argy-bargy that the accountants on the call with us today would understand. And then next minute, the ATA goes silent, and then this is issued straight to the client themselves. Now that caused a number of issues. It caused angst between the client and their accountant, saying, "Well, what are you doing? You told me this was under control." Or it was totally disregarded by the client because I thought, "I know my accountant's dealing with the ATO. This is obviously just another stock standard notice I get from the ATO because I owe money," and just ignored. And we've now seen since these turn into actual DPNs issued, where the ATO has totally disregarded correspondence or work that was being done with the advisor and the ATO. They've basically just drawn a line in the sand and gone down this path. So it is just a blanket approach. So again, for those that actually are with us today that haven't seen these, if you would like a clearer copy, please reach out to one of us three and we can provide a copy, because what a lot of our clients, being our primary clients like the accountants and the advisors, have been actually sending a copy of this to their client database, either whole or those they're concerned about, just reiterating that these could come to you directly. If they do, you need to contact us urgently.
All righty. Next slide, Andrew.
As the ATO has, since issuing those warning letters back in March, has now started to look, to issue DPNs in certain circumstances. So as Justin and I touched on earlier, we are seeing both varieties of DPNs being issued at the moment, and they are very, very similar, which I'll touch on now if you want to go to the next slide, Alice.
Yep, we've just had a question come in, which I might raise now if that works for you. Prue's just asking whether, given the 2020 Clifton decision and the option of no longer being able to enter into payment plans when served with non-lockdown DPNs, have we had any directors take up the option of the new small business restructuring provisions where they can't immediately pay the amount in the DPN? I'll pass off to both Andrew and Justin in a second. One of the things I just wanted to raise in relation to the small business restructuring that we've seen, not only in terms of the obviously having those tax liabilities or lodgements up to date, which would enable people to be able to use that, but sometimes the lack of certainty around what the outcomes might be by entering into the small business restructuring regime can cause a little bit of angst, I've found, amongst some directors when looking at their options in these regards. So I haven't had any that have actually gone down the SBR route. Andrew and Justin, have you seen that?
Yes and no. Yes, in the sense it's an option that's on the table and is discussed, absolutely. Yeah. But the majority of cases, certainly over the last couple of months, it hasn't been the right course of action for reasons nothing to do with DPNs themselves, but as we'll touch on in a minute, it hasn't been the option that makes the clients better off. And this is a topic all on its own that I could talk for hours about it, and probably have and bored numerous audiences to death about the pros and cons of the new regime and why it was touted as being the fix all for everybody. At the end of the day, it's an option, it's a tool available. But as I'll touch on in a minute, the clients that have come to us explore that as an option, as a remedy to these notices. It hasn't made them better off in the sense that, hand on heart, are we just buying time to delay the inevitable, to be sitting back in Justin or Andrew Ellis's office again in 18 months' time, recapping our options, but our options that might be exhausted because the limited funds or personal wealth of personal funds we had, whether it be home equity or parents or whatever it might be, has been exhausted going down this path that we're back to where we started. So it's a very good question. All it's done, it's in the right hands of a sound and a trustworthy insolvency professional advisor is making sure we cover all bases. All it's done is give us another tool to explore since that option was taken off because of that case, that payment plans weren't deemed to be remitting the liability.
Absolutely. Andrew, did you have anything to add to that?
Probably echo what Justin says, but also I think with the small business restructuring, what I've found is the eligibility criteria is an inhibitor in terms of being able to go down that path. I found whilst a number of companies have, appeared to, be perfect for a small business restructuring, plan, they haven't actually been able to go down that route because they hadn't been eligible in other ways. Like in terms of having, a lot of the times it's not having enough funds to, deal with employee entitlements and other things which are required under the small business restructuring regime.
Absolutely, I agree. Thanks for that, Prue. Great question. Moving on to the next slide, I think, Andrew.
Yep. So this is an example which we received. So this is only issued on the 13th of May, and this is a non-lockdown DPN. Now, this non-lockdown DPN was issued, it was probably about $50,000 worth of PAYG withholding. And realistically, it's the notices are very, very similar between the lockdown and non-lockdown. And as you touch on the first page, where I've highlighted, the director has 21 days from the date of issue of the notice. So it's not the date they receive the notice, it's the date that it's actually issued by the ATO. They need to pay the outstanding amount or cause the penalties to be remitted as described in the enclosed notice. So the wording is very vague around how, it's pay the debt really, or needs to be remitted based on the options in the notice. And then in the next page at the top there where it's highlighted, it outlines that the directors can dispute the director penalty notice if they can rely on some of the defences which are available to them under the legislation. I won't go into detail about all the defences because it is a minefield, and we'd normally recommend that directors seek legal advice if they were looking to rely on the defences, which I touched on earlier briefly when we're talking about the withholding tax for associates. The statutory defences to a DPN really are that there's illness, the director has an illness or another acceptable reason for not taking part in the management of a corporation. Based on the cases, it's not just the director was sick for a short period. They need to show that they were sick for an extended period during which the debts were unpaid. The next defence is the director took all reasonable steps. Effectively, all reasonable steps is a very subjective comment, and they need to try and demonstrate that they took all reasonable steps to make the company meet its obligation to pay the debt, appointed an administrator, appointed a small business restructuring practitioner, or wind up the company. In terms of what's reasonable, it's very, and as I touched on earlier, it's not something where you can just say, I asked the director to pay the debt, or I couldn't get the resolution up because, it was, there was the other directors voted against it. There are ways, if you can't get the vote up, to like going to court to seeking to have the company wound up, if you can't get the vote up, or you can't meet any other criteria. So it's something which, there are those defences. And then the last statutory defence is the reasonably arguable position regarding SGC and GST, so net GST. And that just really is where the directors, it's reasonably arguable that they were following the law, what they believe to be the law in relation to the tax obligations during that period. Like they believed that they weren't required to pay the SGC. And, the fact is that where they don't believe they had to pay the GST or the SGC, and there's reasonable argument that the law supports that, then there's an argument there. And that's why I would always say, this isn't simple. And because there's, it's a non-lockdown DPN and there's a potential, that the director's going to be personally liable if they don't act within the 21 days, we'd always say get legal advice immediately just to make sure that you avoid that potential personal liability for not dealing with, dealing with the situation within the 21 days. And then the final one is the defence of estoppel, which I'm not going to go into all the details regarding that, but it's just where effectively where the ATO is stopped from pursuing the debt where there's been implied discussions with the directors regarding them not going down that path of pursuing the debts because they might have been an implied agreement or some other reason. I think there was a case on that back in 97 regarding the implied estoppel, which can be a defence raised by the directors. And then the next slide, Alice, has got the actual non-lockdown DPN. So this is effectively the notice which the ATO relies on effectively to pursue the debts. So the director's personally liable based on the non-payment of the debt when it's not paid by the due date. And then they must notify the director of their personal obligation. And this is the formal notice that does that. And that gives the director the ability to take those actions which are highlighted there, which is the actions which we've touched on previously, which, to meet the obligation to appoint an administrator, appoint a small business restructuring practitioner, or to wind up the company. And as was touched on by Prue earlier, there was formerly the payment plan, which you could negotiate, which effectively stopped that 21-day period. And that would restart the whole process again for the ATO under the old process. But now, since the recent court case, it means that, you know, that there isn't that option there because that underlying debt is due and payable.
Excellent.
Did you have any comments on the non-lockdowns, Justin, that you wanted to add? Or?
No, I think you've covered it all off there, Andrew.
Okay. So then if we go into the lockdown DPNs, they are, you know, as you will see in a moment when, on the next slide, they are very similar to what was provided in the non-lockdown DPN. You know, it says, as with the other, you know, you are personally liable. Like this one was superannuation guarantee charge amounts. And what they need to do is pay the outstanding amount or cause the penalties to be remitted as described in the enclosed notice. But then when you move over to the notice where it's highlighted, they've only got the one option. And to avoid personal exposure, they need to make the company pay the debt. And that's the only option which they have available to them.
It's very confusing, isn't it? I mean, even just looking at the one earlier, I was like, did we have the right one up there? Because, you know, having the two options on the first page, but having it followed with the actual non-lockdown DPN, the nuances are quite small, aren't they?
And I think the fact is, you know, that the whole purpose of these is for the ATO to get the director to, you know, engage with the ATO and hopefully pay the company's tax obligations. And, you know, the notices are framed now to effectively try and get that director to meet those obligations and pay those debts. And from what I'm hearing, a lot of directors are actually doing that since the ATO started pursuing, you know, the warning letters and now the DPNs. The directors are actually coming up with, you know, looking to refinance, looking for short-term funding to actually pay some of these debts.
Absolutely. Excellent. Justin, I might just throw to you then in terms of the observations, any other observations you've been seeing sort of from a very practical perspective?
Yeah, sure. So as with all sort of technical insolvency or legal matters, I think it's important to try and bring it back to sort of relate it to real life happenings. And there's probably none more relevant than DPNs. As I keep saying, they've been around forever and a day. And all three of us have always been a part of our practice in terms of you know, something we're exposed to and helping clients navigate their way through. The issue of a DPN, when we try and break it down into real life implications in terms of, okay, a client's got one, what do I now? Or the client rings us direct, what do I do now? I guess the slides we've gone through today and the information we've covered off, the first step always is, okay, what are we actually dealing with? Do we still have options in terms of, can we avoid personal liability? Or has that horse bolted? Now, the way we can then approach the client's options and, you know, our hat we always wear is, how can we make that client better off? That's our job when you break it down to be quite simple. Now, the observation we've had over the last few months is nothing changes. So if the client were to lob on our doorstep with someone on our, you know, with us today, our job is, how can we decipher the position they're in and how can we make them better off? Now, the way we try and break it down for the clients, and it is, you know, it's panic stations. When I get one of these notices, where they've had a meeting with us before, say, look, you could be okay. Your plan of keeping on with, you know, some guidance might be okay. So have at it. But if you were to, a number of events were to happen, you know, such as stat demands and bankruptcy notices or all that sort of stuff, or we mentioned DPNs, we're dealing with a corporate entity, and sort of educate them in terms of, if you get one of these, it becomes panic stations. And then, you know, the obvious happens and we get one. So nothing changes in terms of the tools we've got to make them better off and the approach to how we can make them better off. All it does, it just starts the clock ticking. And that's the best way we can describe it to clients. And the 21 days goes pretty quick. Even if we get a phone call when they first get it, the clock is ticking. So the time frame we've got to meet with the clients, assess their options and have them understand and get their head around those options, you know, it can be difficult, let alone when you get one when there's a day or two left. That's even more problematic. But again, and we see it all the time. I saw two last week where, what does this notice mean? And it's the horse is bolted to expire. So non-lockdown, but the horse is already bolted. Then you have that you know, awkward conversation about what, because you sat on it for a week or two too long is what it means. But to break it all down, probably one of the biggest observations I've seen, and it was hark back to that earlier great question we had about small business restructuring, you know, how pertinent it is dealing with DPNs. The biggest problem we see is harking back to the warning notice. Now, the DPNs themselves are catastrophic when they're received, if not handled correctly. The warning notice has created the same set of problems. And what By that, I mean, when the warning notice is received, that Andrew put up before, it says, you need to contact your accountant or enter into a payment plan or pay the amount. The default position has been enter into a payment plan. And quite rightly, the human nature element is, okay, I want to avoid personal liability, I'll enter into a payment plan. Now, whilst not covered under the DPN regime we're talking about today, that is creating another problem for people down the track. So those that are with us might understand the concept of preferential payments in any liquidation scenario. With our liquidator hats on, the ATO are the easiest people in the world to chase for preferences historically, because for a number of reasons. I could talk for hours about that again on its own. But the reason why it's important here is, if we were to recover a preference payment from I call it a trade creditor with no personal guarantees, then there's no real impact on the clients themselves. However, the ATO holds a statutory indemnity against company directors for preference recoveries made by a liquidator. So long story short, for those that haven't been exposed to it, the client enters into a payment, they get the shot across the bow, GPN warning. Their default position, quite rightly and understandably, is to enter into a payment plan. But if that point in time it's not done in consultation with their accountant, their advisor, or their trusted insolvency professional, what that can do is solve one problem, but create a bigger one, or as even big one down the track. And by that I mean, we get a warning notice, I don't want a DPN, I'm going to do what I think and enter into a payment plan. Problem solved. I enter into a payment plan, I'm paying, the one I've got at the moment in front of mine, paying $25,000 a month. They pay $25,000 a month. They are doing nothing more than buying time. That's all they're doing. They're buying time because that's what I have to do. I buy time so it happens down the track. It just gets the ATO off my back for now. If we're just delaying the inevitable, hand on heart, if we were to sit down with that client early enough before that payment plan was entered into, when this shot across the bow was received, we would sit down and it's a very difficult conversation to have, but we would have that conversation and say, hand on heart, are you buying time? Or if this payment plan is successful, we get rid of the ATO exposures, are you back on your feet and tracking well? If that answer is no, or even I don't really know, the company falls over. If it ends up in liquidation eventually by their hand, or the ATO, or voluntary or otherwise, and there is a preference recovered from the ATO, that amount can then recover from the director from the ATO for that amount. And every single appointment we've had over the last, I'll say 3 months, this has been paramount in terms of, are you making things worse for yourself by having a DPN? And every single conversation we've had as a result of that shot across the bow, or the warning DPN, has been that. Yes, by all means, if you want to enter into a payment plan, do so. But please be aware that you could be solving this problem and making an even bigger one down the track. And it's something else that I don't think a lot of practitioners there understand too. We've got a lot of clients who are very savvy, very well educated in terms of this, because they're used to us banging on about how important DPNs and things are. But they don't quite join the dots in terms of, well, let's buy some time, let's enter a payment plan, because that'll keep them at bay for a time being, without really thinking about the bigger plan as, hand on heart, are we buying time? And if we are, then that's the time to talk, the early question about SBRs and VAs and the like, or liquidations.
I think that's right. And talking, in terms of certainty, like I think a lot of people that I talk to, they want to know what are we doing and what's the outcome. And I think sometimes in terms of entering into, even if they are formal payment arrangements, not formal or informal, but it's not a certain outcome. It's not, this is what we do, and then the fate is decided. And whilst that's a scary concept, I think, to enter into, signing off on the deciding of your fate, or the company's fate, it is something that I think needs to be looked at right in those early stages, because you're correct. And the amount of applications we've had in terms of preferences, where it's very easy, for the tax office to come back and pay an amount, but then they go straight away after the director. It's happened more and more. It's rare that it doesn't happen these days, I think. And it is, as you said, just buying time, but still sort of opening the gap of that personal liability issue again.
I think the key there is just, getting early advice about, the holistic situation of the company, to make sure that you're taking in all issues when you're making a decision regarding the company's future, not just buying time with the payment plan. It's considering everything as a whole at that early stage. And that's, what I always try to say to accountants and other advisors, let's just have a discussion early so I can help you work out what the best course of action is early. And then it's up to the directors, provided that the ATO or others aren't pursuing their debts aggressively to make a decision that's the best, that's going to suit the company and all the stakeholders.
No, look, absolutely. I've just flicked that slide onto the questions. If anybody has any questions, please pop them in the chat and we'll come to them. I am conscious of the time, but maybe we can just finish off, if we are waiting for any questions, Andrew and Justin, with maybe a final note, final thoughts on the matter, any sort of key points that you want to get across?
For me, it's all about education, making practitioners, making their staff aware and their clients aware. Whether that's as simple as having us come along and do an in-house training, and it is often a refresher for some. So the presentations I've been doing over the last fortnight on DPNs in particular, half the room it's a refresher, and half the room it's the newer staff or those that haven't quite been exposed to one, and understanding everything we've gone through today. It doesn't need to be catastrophic if it's handled right, or if things are set up correctly too. And to the earlier point that Andrew said, the early intervention, I guess the phrase I leave them all with is there is never too early, but there is a too late to have a discussion. And it doesn't need to be a discussion, and we're not going to necessarily talk about liquidations and bankruptcies. We're talking about options and arming them with the knowledge. Because if directors understand that they could make themselves personally liable if they don't do certain things, or if make things worse themselves by doing certain things, the earlier they know that, the better.
No, I think that's really great advice, Justin. Andrew, what are your thoughts?
What Justin said probably caps it off, but in terms of my slant on it would be making sure that that the directors and their advisors know what the impact for that director is personally in relation to the DPNs or their tax obligations. Like, we can get in early, we can say, make sure you make those lodgements, make sure before you get the DPN, you've got all these options available to you. Make sure you do whatever you can to mitigate that personal exposure, because obviously once the horse is bolted, it's hard to change things. So for me, it's the education piece is paramount, really. And I do the same thing, is go out to accounting firms and just give them just general assistance through what is a minefield really in terms of the DPN regime and how that applies to relevant people, like the directors. It is quite difficult, and you don't want to. Sometimes it might be the case where they can't avoid personal liability. So it means that they've got to think of other things, like an appointment isn't the right cause of action because they're still going to get that personal exposure. So it's about working out what's the right situation for everyone involved, and that's what we offer.
I think that's really good point. And for mine, it's about getting advice from the right place, to be honest. So making sure that, when things happen, and, we don't operate sort of as islands either. When we're able to talk to people about things that are happening, we talk to not only each other, and we talk quite a lot about different matters that come across our desks, but we have a lot of great advisors that we talk to and can use as soundboards or bring into situations as well. And I do think that getting that that sort of specialist advice early, as you said, Andrew, it's not going to be the same for everybody. It's not cookie cutter, and sometimes it's a long game. But just being able to talk early, Justin, I love your, it's never too early, but it can be too late. Pros, I think that's really relevant. So thanks for that. We haven't had any more questions, and that's probably time. So I'll thank you all today for joining us. And remember, if your clients do require any assistance regarding DPNs or insolvency, bankruptcy, restructuring generally, feel free to reach out and get in touch. Have a great afternoon.
Thanks, everyone.
Thanks, guys. Thanks, Alice.
Thank you.
Really appreciate it.